Real estate investors have created the largest housing bubble in US history right now in 2022. Not only have they purchased all of the available homes for sale and locked the regular American homebuyer out of the market, they've also pushed prices so high that we're inevitably going to see a collapse. I mean, seriously, take a look at what these real estate investors are doing. A Goldman Sachs backed firm just bought an entire Florida community for $45 million, according to this article from the New York Post. The article goes on to say a pair of Goldman Sachs-backed ventures gobbled up an entire rental home community in Palm Bay, Florida last month for a cool $45 million. There was 87 properties in the portfolio, which comes out to $525,000 per home. That purchase price by these Goldman Sachs-backed investors is an astounding 52% higher than the typical value of a home in Palm Bay, according to Zillow, and is more than 40% higher than the homes that are selling for next door. If we go here on Zillow, you can see the single-family rental community that these investors bought right here, and right next door, D.R. Horton, the largest home builder in America, is selling homes to regular buyers, and I gave them a call and found out I could buy the same size home for $370,000 from D.R. Horton directly. So not only are these Wall Street-backed investors taking 87 homes off the market that a regular home buyer could have purchased, they are paying a 40 to 50% premium above market for these homes and thus inflating the property values in Palm Bay, Florida. And this investor buying deluge, which is depleting inventory and pushing prices up and making the bubble worse, is not just a problem in Florida. Because according to data from CoreLogic, there's been a big surge in investor home buying across many parts of America. Consider that back in 2019 and 2020, according to CoreLogic, there was about 835,000 homes purchased by investors. That investor home buying then exploded in 2021 all the way up to 1.4 million, a massive 62% increase. And what's crazy is that while the orange bar, the investor purchases, were going up, the blue bar, the number of homes sold to normal home buyers, actually went down from 2020 to 2021. What this says is that the surge in the US housing market over the last 18 months is not due to fundamental demand from end user home buyers, but it's due to investors coming in, treating the housing market like a casino and buying up homes left and right. The way that many of these investors are accomplishing this feat is by raising capital from Wall Street. So the fund that bought that community in Florida, which is called Cypress Bay, 87 single-family rentals, looking at the capital stack here, which comes from Fundrise, the company which ended up buying this property, we can see 24 million of the funds to buy the property came from a senior loan, most likely Goldman Sachs, accounting for roughly 53% of the purchase proceeds, while the remaining 47%, the remaining 21 million, came from Fundrise via crowdfunding equity. Now you might be saying, what's crowdfunding equity? Well, that's kind of like a GoFundMe page for buying a real estate property. Fundrise goes out there to their retail investors and says, hey guys, we're buying this property in Florida. We need to raise some money. And through a pool of hundreds of thousands of investors investing $2,000, $5,000, $10,000, $15,000, they add up enough money to finally complete the acquisition. And so the crazy thing about this purchase in Florida, as I'm about to show you many of the other investor purchases around America, is that while they use Wall Street debt to finance the transaction, they actually raise the equity mainly from small-time retail investors who want to be able to invest into the housing market, but who might not have the money to purchase a home for themselves. And a lot of you would be surprised to know that of the 1.4 million homes sold to an investor in 2021, 670,000 of them, according to this data from CoreLogic, were sold to small investors that own fewer than 10 properties. Meanwhile, 400,000 of the homes were sold to medium-sized investors that own between 10 and 99 properties, while only 300,000 of the homes were sold to large investors that own over 100 properties. And so the largest share of investor demand in the housing market does not come from big Wall Street firms. It comes from small investors that do crowdfunding, or they try to buy a home on their own. And the reason there's so many small investors buying and selling properties is because it's really easy to do so. Technology like Zillow now makes it possible, for instance, for a rich tech worker in California to buy homes in Georgia or Florida in Texas without leaving their house. They can scroll through Zillow, see the listings, call a local realtor and say, I want that home. The ease of access and marketability for real estate investors to buy into the housing market was then exacerbated by the Federal Reserve cutting interest rates to all-time lows and printing tons of money during the pandemic. That made capital very cheap, very abundant, very available. It was easy for investors investors to get a loan to buy a house, or if you wanted to raise a fund, say you want to do crowdfunding, it was pretty easy to find people to invest in your deal. And this created an environment where in 2021, in the beginning of 2022, we've had so much capital, so much investor capital just chasing homes, chasing deals around the US housing market, desperately making cash offers and pushing the regular home buyer out. But we need to stop right here and address the elephant in the room, everyone. And that's that the big problem, the truly big issue with all these investors buying homes is not just the short run effect of making the housing bubble worse and depleting inventory and pushing out the home buyer. But I think the even bigger issue is the long-term effect, and that's increased volatility in the housing market and an even greater likelihood of a crash. That's because the record high home prices we see in America right now and the record low inventory now require this level of investor demand to remain stable or grow into the future. When you think about the housing market right now, think about the fact that investors in the second half of 2021 bought 18 to 19% of all the single family homes in America, literally 1 out of 5, double the long-term average. What this means is that investors need to continue buying this many homes for the housing market to support itself. And if there's any slowdown in investor buying, or if some investors turn into net sellers, then that will create a big problem for the housing market, creating instability, volatility, and ultimately a greater housing crash. And I predict, folks, that over the next several quarters, we're going to see a massive drop-off in investor home buying in America, because now that the Federal Reserve is tightening monetary policy, they're taking away all of those easy credit conditions from 2020 and 2021 during the pandemic. That's going to ultimately mean there's going to be less capital floating around to invest in real estate. And while this is going to be an issue for the housing market more broadly and cause prices to go down and inventory to go up, it's going to be a big issue in particular in the areas in red on this map, where data from Redfin shows that the highest share of investors are buying. Places like Charlotte, Atlanta, Jacksonville, Florida, Phoenix, Arizona, Miami, Florida. These are markets where investors are buying over 1/4 of all the homes. So these are the cities that are going to have the biggest housing crash, and in particular, certain zip codes in these areas where over half the homes are purchased by investors are going to get hit really hard, because as the Fed continues to tighten monetary policy in 2022, that's going to mean there's less money to go around for real estate investment. Now, I know some of you are skeptical of this. I think a lot of you believe that we're going to see investors, both big and small, just buy a lot of homes into the future no matter what. And so I want to give you all a specific example of how the Fed tightening monetary policy is going to create issues in these investor-driven housing markets. So we know that Fundrise, that Goldman Sachs-backed investment firm, purchased the property in Palm Bay for $45 million. Based on the prevailing rental rates that are on the website for this rental community, it looks like they're projecting to get, when the property is leased up, about $2.7 million in revenue per year. That's a 5.9% rental yield. However, we need to back out a loss for vacancy, we need to back out management fees and expenses, and after we do that, we get to net income of about $1.8 million for this property when it's leased up, roughly 4% of their acquisition costs. 4%, that's not a lot of room, that's not a lot of breathing room, especially when you consider the fact that Fundrise, the crowdfunding company, needs to pay Goldman Sachs interest on that $24 million senior loan. And so it's really important for you all to understand this. When you buy an investment property at a really low rental and income yield, that creates a lot of interest rate risk to the value of that investment. And this could happen in two different ways for Fundrise. Number one, with interest rates and bond yields going up, some of their investors might say, wait a minute, why would I want to invest in a real estate property for a 4% yield when I can buy a highly liquid, risk-free US Treasury for a 3.3% yield? Or when I can buy a AAA rated corporate bond for a 4.2% yield. Additionally, there could be issues with that debt that I think is from Goldman Sachs on that property, because I'm betting that debt is floating rate. Most often when funds raise debt from Wall Street to go and buy real estate, it's floating rate, which means that interest rate hikes are going to increase the cost of that debt. This increasing cost of debt could squeeze the profit margin on the property, which would make it even less desirable for investors going forward. And by no means is Fundrise the only real estate fund right now buying homes at very low investment yields and accepting low returns. If we look at data from Zillow, we can see that the profitability, aka the rental yield for real estate investors, is the lowest it's ever been in America today. And ultimately, I believe the runway for real estate investors to jack up the rents is running out, because while we've had a big surge in rental rates over the last year in America, that 15% surge in rental rates is almost 3 times higher than the growth in wages, according to data from the Bureau of Labor Statistics. So very likely renters are feeling the pinch and can't afford much more. On top of that, we have a record number of overall homes for construction, but particularly we have a record number of apartments for construction, many of which are going to get delivered in 2022 and put downward pressure on rents. And so unfortunately for a lot of these investors, they're buying at a record high price at a record low yield into a rising interest rate environment, into a situation where the rental market in America, in my opinion, is likely to soften into the future. And the net result of all of this, my big prediction, is that we're going to see a big drop off in investor demand in America in 2022, and that this is going to facilitate a housing crash across the country more broadly, but more specifically in the Sun Belt markets where investors are buying the most homes. Let me know in the comment section if you agree with me. Do you think time is running out on these investors, or do you think they're going to continue buying? Also, make sure to smash the like button. That's the best way you can show your support for this channel and the content I produce.